Hi, good afternoon. Thanks for joining us. What looks like a record-setting day for the S&P 500. This is Brian McGann, and today I'm joined by my colleague Joe Healy, Managing Director here at Beacon Trust. In addition to being heavily involved in coordinating our research efforts, Joe manages our high dividend equity strategy, as well as being a co-manager on two of our other strategies, income and appreciation and the core equity strategy. In a few moments, I'll ask Joe to give us about 5 to 10 minutes of his insights into corporate earnings season, which is currently at its height. We usually begin these webinars with a more of a formal look into our economic outlook, but today we'll just settle for a quick update. Happy to say that really not much has changed in our view. Recent data points are still consistent with a slowing economy instead of a recessionary one. While trade issues still loom over global economic growth, here in the U.S., we're still enjoying a robust employment situation, healthy consumer, low inflation, and accommodative interest rates. We've had the Federal Reserve cut Fed funds target rate by 25 basis points twice this year, and we expect at least one more cut in 2019, quite possibly this week. Because of this, we've not made any macro recommendations for asset allocation changes in an effort to become more conservative. We do expect volatility to continue to pick up within the financial markets, but currently would do that from a more opportunistic standpoint. With the slowing economy from about 3% in 2018 to about 2% this year, there's been some concern amongst investors within corporate earnings. Over at least the past 2 quarters, the words possible earnings recessions have crept into the news headlines, so we thought this would be a great educational topic to address for our clients. As with all headlines, they can be thought-provoking and sometimes misinterpreted, so a big part of our job is to make sure our clients are aware of what's going on underneath. So before I turn it over to Joe, I'm just going to cover a few logistics. There's no slides attached to this webinar, so if you're looking for them, we decided just to have a brief conversation instead of having slides. Each call is on listen-only mode. If you're logged into the webinar, you can submit a question in that question box. You can also email us a question at support@beacontrust.com. We're recording this call, and we're going to post it to the Insights section of the Beacon Trust website. And if you'd like a personal copy of it, we can certainly email that to you following the call. So without any further ado, thank you again, and I'm going to pass the call over to Joe.
Great. Thank you, Brian. And good afternoon to our clients, and thank you for joining us today. As we all know, U.S. companies file their financial results with the SEC on a quarterly basis. And it's a window for investors every 3 months to see how things are going for the companies represented in their equity portfolios. Corporate earnings season for Q3 is currently in midstream, and the earnings fire hose is wide open. As of Friday, 40% of the companies in the S&P 500 stock index have reported earnings so far for the third quarter, or Q3 of 2019. Now, this afternoon, we wish to provide a few key timely insights for clients as news continues to be dominated by headlines about results for companies. Sometimes these headlines can be misleading, so we'd like to dig into a few data points from recent earnings results and share some relevant insights. Now, to address a key issue on the minds of many, Brian mentioned recent headlines seem to cast a rather negative light on trends in earnings results for larger U.S. companies, like the ones in which Beacon focuses within our active equity portfolio strategies. And as you noted, some pundits feared the notion of company earnings comparisons being down versus a year ago here in the midst of a slower economy and ongoing global trade uncertainties. In fact, some would infer that valuation measures, such as PE ratios, are at risk of being elevated for U.S. stocks through a shrinking earnings denominator. Now, that would certainly be an unwelcome scenario for investors. In this presentation, we wish to allay any such fears of an imminent earnings recession. So let's get started by going back and looking at the last couple of quarters in corporate earnings data, beginning with Q1 19. Q1 reflected the full effects of slowing economic growth, successive monetary tightening moves by the Fed over prior years, and ongoing headwinds and uncertainties from the lingering U.S.-China trade fight. So the first quarter for the companies in the S&P 500 index in aggregate began 2019 rather quietly with a plus 3% year-over-year earnings gain for Q1. But underneath this plus 3% number, Q1 19 actually brought the first decline in net profit margins for the companies in the S&P 500 since 2016, with margin pressures mounting from rising costs related to labor, logistics and transportation, tariffs, etc. Additionally, pricing power for companies proved to be quite limited in what is an intensely competitive global economy. As might be expected, with profit margins under pressure and earnings comparisons so close to flatlining, 2019 has unfolded as a year with reasons for optimism coexisting alongside some added caution. Now, moving to the second quarter, let me share some data points regarding earnings expectations as we entered Q2 reporting season for the companies in the S&P 500 stock index. Consensus expectations for companies in the S&P in aggregate were for a quarterly earnings decline year over year on the order of -2% for Q2 19. Now, this would have represented the biggest earnings decline for S&P 500 companies since Q2 of 2016. And this negative year-over-year comparison for Q2 19 would also have represented a deceleration from Q1's modest aggregate earnings growth rate, the 3% that I mentioned. So reflecting these expectations for negative earnings comparisons, the associated headlines highlighted the challenges afoot for large companies. Important within this slowing of earnings comparisons was the ongoing moderation in global economic growth in the year to date, as well as recent declines in corporate profit margins. As it turned out, though, Q2 earnings results ended up beating the rather gloomy expectations. S&P 500 earnings in aggregate actually advanced by 1.7% in Q2, and that's almost 4 percentage points above the expectations entering earnings season, that -2% that I noted earlier. Furthermore, the median company in the S&P 500 posted earnings growth of plus 6% in Q2, well ahead of this headline plus 1.7% number. Now, this kind of difference is quite possible mathematically, and that's because the interim period results comparisons of companies with heavier weights in this market capitalization weighted index can vary markedly from those of the average or median company. And Q2 was one of those instances. As to profit margins, while net margins did post modest declines again in Q2 across most sectors within the S&P 500, they fell by less than previously expected thanks to lower than forecast corporate tax rates. And this was much like the Q1 experience when overly negative earnings expectations for comparisons were exceeded by S&P 500 companies, aided importantly by lower than expected effective tax rates. Finally, Q2 earnings results at the company level beat expectations for fully 76% of the reporting S&P 500 companies. Now, that 76% result is actually above the 74% average of the prior 4 quarters, which is very constructive results versus expectations. Thus, the overall takeaways on Q2 earnings growth were as follows: a continuation of modest growth, ongoing challenges to margins for sure, but overall results better than feared. Now let's fast forward here to Q3. We recently entered the third quarter's reporting season, and as we did so, consensus expectations for companies in the S&P 500 in aggregate were for a quarterly earnings decline year over year, again, on the order of -3% for Q3. Turns out it's much like the picture was a few months ago as we approached Q2 earnings season, with an outlook for negative earnings comparisons then too. And it's worth noting on the sentiment front that this consensus expectation of -3% for Q3 was much more moderate as of just June 30th, when it was just negative 0.2% for Q3 comps. So sentiment around Q3 results had been quite modest, and even these modest expectations slid considerably over the summer months. And think of all the headlines we all heard of in August about potential recession, et cetera. So now let's see what the Q3 earnings picture is actually looking like today. It's still somewhat early, with only 40% of the S&P 500 companies having reported thus far, but fully 81% of them have reported positive earnings surprises versus expectations. And that's well above average. It is quite possible that sentiment became too negative about companies' Q3 prospects over the summer, and perhaps the negative comparisons will moderate as earnings season progresses, much as with what happened in Q2. And as always, it's instructive to look at the expectation for the median company in the S&P 500, which is for a Q3 earnings comparison to result in a growth rate of plus 3%. This is also reminiscent of the Q2 experience, when the median company outpaced the index's aggregate earnings comparison by a significant margin, which I mentioned earlier. So what's the Q3 earnings look at this point? Well, to us at Beacon, based on the data coming in, it's so far so good. And there's a fair chance that Q2's experience of exceeding expectations might just repeat itself here in Q3 earnings season. To bring this earnings analysis closer to home, let's look for a moment at the company-specific level and consider the earnings progress of key holdings across the economic sectors. Stock selections in Beacon's equity strategies, such as J.P. Morgan, Union Pacific, Johnson & Johnson, Sherwin-Williams, etc., are examples of companies rising to the challenge this earnings season and exceeding investor expectations with their Q3 results. Several of our holdings have, in fact, marched to all-time highs following their Q3 conference calls and maintained these recent stock price gains. S&P 500 companies in general are nicely advancing their financial results, despite the trade war being well into its second year, and also as companies bump up against the tough comparisons to last year's Q3 results, which were bolstered by year one of U.S. tax reform. The bottom line is that it's still onward and upward for most of our companies on the earnings front. Corporate America is working hard for us shareholders. The numbers are there. So a few conclusions. Overall, there is no earnings recession in sight, and valuations for U.S. stocks remain very reasonable, especially within a setting of subdued inflation. On balance, we are quite encouraged by the ability of our large and mega cap portfolio companies to roll with the punches, to manage themselves very well, despite all of the obvious macro challenges out there. And looking under the hood, the median company also continues to report steady earnings growth, exhibiting durability across the breadth of U.S. companies. So considering the key fundamentals which we track related to corporate earnings and equity valuations, the basic backdrop remains constructive for U.S. equities. I'd also add here in closing that we are also quite encouraged by the underlying price action in the stocks of bellwether U.S. companies and industries of significance, including technology, financials, industrials, transports, home builders, et cetera, et cetera. And with that, Brian, let's open up the call to any questions the clients may have.
Thanks, Joe. The only question that's arisen so far looks a little bit past this year, and looking at the outlook for 2020, are there any early indications for what growth could be for 2020 in terms of earnings?
Yes, indeed. I track that very closely, and the story there is for a nice rebound. When we look at the consensus expectation for 2020, S&P 500 index earnings growth, that look is for a plus 9% comparison in 2020 over 2019. So that's a stabilization of margins, a return of volume, and perhaps some pricing power as companies catch up on price cost on the margin front.
Great. We really wanted to keep this brief and at a high level. And again, I think this reinforces our thoughts for the the balance of 2019 going into 2020. So, pretty consistent with what we thought going into this year. Slowing economy, but not a recessionary type environment. Earnings growth continuing on, which leads to reasonable valuations in terms of the equity market. So, again, nothing within the headlines has led us to believe anything different. Our expectations have so far been met. And again, we haven't been recommending any sort of change to asset allocation targets at this point. We still have a lot of positives going on within the economy. Like I said, headlines can sort of come out and be a little bit misleading or something like that. So we like to take these opportunities just to get a quick educational point out there to let you know really what we see underneath the hood. So I hope you enjoyed. Again, we recorded. We'll be posting it to our website in the insight section of the website. And please feel free to reach out to any member of the Beacon Trust team should any further questions arise. So with that, on behalf of Joe and myself, thanks again for taking the time. Enjoy the rest of the evening, and we hope to talk to you soon. Thank you.